right, we're going to get started now. This is Dave Beck. I am the insurance specialist with Egan Berger Weiner. Today, I'm happy to introduce that we have Brian Shepard from OneAmerica to go over our third quarter webinar called The Great Income Gap. Brian began his career selling annuities and long-term care and life insurance back in 1999. In 2000, he specialized just in long-term care and currently manages a long-term care book in excess of $1 million. Since 2004, he has worked in brokerage as an external wholesaler to help general agencies and brokers increase sales of long-term care and asset-based solutions. He holds a certificate as a certified long-term care designation, has a Bachelor of Science in Business Administration from Central Pennsylvania College, and lives in South Central Philadelphia, Pennsylvania. Sorry. Hopefully he's not an Eagles fan or a Steelers fan, but we'll let that go for another day. And with that, Brian, it's all you.
All right. Well, thank you, David. And most importantly, thank you for the folks that are on our discussion today. I hope you take away from this really about 30 or so minutes of intriguing information that allows you to think potentially different about long-term care planning. And I know you're in good hands with EBW Financial. They've been offering long-term care solutions as really a cornerstone to any good financial plan for many years. So this is not certainly new in discussion, I'm sure, but I've been told many times over my career, Brian, if you change the way you look at things, the way you look at things change. So we're going to focus on what we call the Great Retirement Income Gap. And what we really are trying to say here is, have you considered if something were to happen and your income needs skyrocketed? So kind of keep that front of mind when you think about the conversation we're going to go through today. All right, so by way of disclaimer, just make sure that you're having a customized conversation with your financial advisor, because this is not a one-size-fits-all. And that's why when you talk through insurance options, it must be in the best interest of you as the client. All right, now, do you have an income gap in your strategy? Maybe, maybe not. But I think everyone on the discussion today would consider how they would plan ahead for any future needs for long-term care. So preparing for retirement, let me paint a picture in your mind's eye. Imagine climbing a mountain, right? So we get to the top of that mountain and we plant a flag. What have we done? If we have an analogy for our working years, we've done a lot of heavy lifting. We've gone uphill sometimes, maybe a little bit of blood or some scrapes, but we've managed to get to the top, and we now are through the accumulation phase of our life, planning and saving. Now we're heading back down that mountain safely and successfully into the distribution phase of our life, our retirement years, right? Well, what are some things that could really cause this issue or potentially have an impact of the descent? Well, what could it be? Having enough income, or low interest rate environment that we're currently in my entire career over 25 years in the industry, I've never seen interest rates actually go on the increase. Healthcare costs, they're not going down any time soon. And long-term care cost. When we think about long-term care cost, I'll put it into perspective. Average cost out there right now for a private room in a facility is over $100,000 a year. Now, if we just apply about a 3.5% medical inflation rate to that, what would it look like in 20 years? I'm sorry, in 10 years would be over $144,000, and in 20 years, over $200,000. Now that's average. What I would say Main Street care costs. And ironically, the more affluent our clients are, generally the less average they are and the more that their care costs over that average. So how do we understand what the impact to the long-term care costs are? Well, there's a couple other, I call them X factors, but dynamics that are at play here. The first one is higher demand, right? There's only so much of time in the day and so many people that are skilled to take care of you. So how is that going to affect the cost? The second thing is we're living longer. Now, I like to think of us as the wear out generation, not the die out generation. We're going to be made of titanium and live till we're 100 years old, right? That's our mentality. But ironically, there's a lot of truth in that. And then the third thing that really can affect the care needs is the family dynamics. In other words, who's the point person? Who's going to get the phone call at 2 a.m. if they were the one that is going to be taking care of that loved one? Have you talked to them about that? These are all significant dynamics. And the fourth, and certainly not least, is the government. Now, we're in a political environment, doesn't certainly matter the views that you have. Could we all agree that the government probably isn't going to come out with any robust programs that is going to lessen the cost or lessen the burden financially or the family for care needs? So all of those things are going to play a role and potentially drive up those costs even more. Now let's look more specifically at Alzheimer's, which is really near and dear to my heart. My family's been affected by dementia and Alzheimer's in previous generations. And so when you think about that, there's over 5 million Americans right now across the country, 1 in 10 over age 65, that are living with Alzheimer's disease. Now, fast forward to the middle of this century, just 3 decades from now, that number is going to more than double. Now, what kind of burden is that going to put on facilities and families? So now consider this from just a average length of stay. And these numbers are out there. You can Google them and find this information. It's well noted in the industry. Men, on average, about 2.2 years. I've often been told in face-to-face seminars like this, someone will raise their hand and say, yeah, men die first because they want to, right? And women really carry the burden when it comes to long-term care on average of over 3.7 years that they'll need to look left or right and rely on somebody else for their needs. So if you just take that statistical data and you say, okay, 20 years from now, it's going to cost almost $500,000 for one male and over $750,000 for a female on average. And then heaven forbid, Alzheimer's comes into play and you need care for a couple decades. My grandfather, 12 years, by the way. It could cost well over $4 million. Now, here's some more information that I think is staggering. These are the top 7 insurance companies by way of paying claim for long-term care needs. And ironically, you're going to see the red boxes here that are illustrating that males are receiving more care, the longest claims, than females. So I guess that old adage of men dying first because they want to isn't exactly true. But my point in this discussion here is that you don't know what the averages are, right? Are you average? Maybe, maybe not. Now, statistically, and this is right, the government guide on long-term care, 70% of Americans that cross the threshold of 65 years or older are going to rely on someone else for their care needs. And 1 in 5, 20%, will need care for more than 5 years. Now, I've just really given you the news by the numbers the last couple minutes, but I want you to think about it this way. Could we agree that it's either 100% chance or a 0% chance for you and your family to deal with this issue? So never mind statistics, although important to analyze, it's really about the consequences. Is it going to happen to me? Do I want to plan ahead for it? And in the absence of the plan, have to crisis manage. Another thing that I get questions on a lot as an industry expert is, well, if the average is only a couple years for men and maybe 4 for women, I'll just play the odds. Well, think of it this way. If your feet were in a bucket of ice water and your hair was on fire, on average, you're comfortable, right? what I'm trying to say is that it's a perfectly meaningless number. Nobody's average. It is a statistical data put into a melting pot to show you a data point. Now, let's think about the differences in long-term care planning. Is it about statistics? Maybe I've proved to you already that it's really not. Is it about facilities or home care? Yes or no. Is it about really emotional conversations? By the way, the day after Thanksgiving, Black Friday, is the highest claim opening in the long-term care insurance industry. Why? Families get together, people fly in from coast to coast to see their loved ones, and they're having these conversations. At some point, it's no longer a laughing matter of, yeah, I'll just go out in the woods and get lost and never come home, or I'll use a gun, or my kids will take care of me. It becomes a really serious matter. And in fact, it's happening in front of their very eyes. But I want to compel you to think of this as just another bill that you are required to pay. It's another expense in retirement or pre-retirement that causes your income to skyrocket. And if we can't fill that void with additional income, then we have to start invading assets, and that becomes a spiraling effect down to zero. So do we have enough income to meet those needs? Can you call your financial advisor at EBW and say, hey, my spouse just needed care. I need to pay this care cost, and it's this amount of money. Will that affect my lifestyle of me currently as a healthy spouse? Or can I still give to the alumni or the church or that next generation that I had plans of doing for my legacy? All of those things should be taken into consideration. So now the concept really here, question you should ask yourself is, in retirement years, what could cause those expenses to really outweigh your income? Now, hey, we could analyze this significantly, and I encourage you to do so. But now let's look at things, significant things in your life, your home, which you have a high amount of equity in, maybe automobiles or other real estate, other investments. But generally, we have what? Insurance as an umbrella to protect that. Even if we could pay for it out of our own pocket, we tend to use insurance because we pay pennies to have peace of mind to protect dollars. And we hope it never happens, right? So if your income needed to increase maybe 50 or 70%, probably even higher for some of us, should your care needs arise, how are you going to fill that void? What's going to happen in that situation? And that's why it really is now a cornerstone of conversation heading into retirement as to why we should consider the consequences of long-term care needs. Now, why we call this discussion the Great Retirement Income Gap, I think, is now evident, right? If we can't fill that back, it becomes that void, that gap, it becomes a vacuum, and that erodes even the best thought out financial plan. I like to keep it very simple. Imagine going through a stoplight. You have red, yellow, and green, right? It's all green if your health is good and your income is satisfactory to your retirement lifestyle. Everything is amazing. Yellow is, hey, do I hit the brakes or do I go? Maybe there was just a subtle health change and your expenses went up. Red means there has been a significant diagnosis, and it doesn't have to just be the major things like dementia, Alzheimer's, or multiple sclerosis, all those things that we hear about in the news. It could be as simple as a car accident that you're no longer able to rehabilitate from. And that's where this concept really comes into play. And now let's paint a picture of your current expenses. So that is the vertical axis. And then your retirement age, that horizontal axis. And as we project out, we have that green light, the solid blue portion of the diagram. Everything is good, right? There's really the go-go years, the slow-go years, and the no-go years. So we're still in the go-go, maybe a little bit of the slow-go years. And all of a sudden we get to maybe 70, 75 years, we're starting to slow down, maybe a diagnosis happens or our health changed and we're leaning on the family to help us a little bit. You see that orange part of it illustrates what the gap really is, and have you planned ahead for that? You see, insurance is not the plan. It allows the plan to execute better and longer. And you could probably relate to that with anyone that is a planner and saver and how they use insurance as a tool. And that's really what this gap represents. Have you filled that gap? So what are the effects? Well, you could suddenly need additional income that could affect any long-term or any financial plan. So could we agree that this is an income problem, not an asset problem? You see now why we don't live off the assets that we've accrued over our life. We live off the income that the asset generates. And if we start invading that principle, that's where it starts a steep slide downhill. So when we think about self-funding, what happens? We start to liquidate accounts. We find monies that are more cash equivalent, liquidity in the portfolio. Maybe it's that annuity that was sitting there on the sidelines, dormant. It was the what if money, I like to call it. Or just simply money that is in that portfolio that would be used before you had to burn through a 401k or an IRA. Now, let's turn the corner and say, okay, what could we do? What are some things that we could look at? And insurance is one of them. But by the way, I'm here to tell you that not everyone, not even everyone on this discussion today, will even implement insurance. Why? Because maybe your health has changed to the point where you can't get the insurance. That's why we need to prepare ahead while we're still relatively healthy. Or maybe financially, it's just not in the best interest of you to do it. So I would say that if I were in front of 1,000 people, not all 1,000 will end up owning an insurance product, but all 1,000 deserve to have a plan. Work with your financial advisor. Maybe it's a tough conversation with an elder care or estate planning attorney to ease that burden if it's already close to you. But if you have the means and you plan ahead, could you use insurance to your benefit? Could you use it as leverage? I think you could. So what we do, and this is your financial advisor, David and his team are very good at identifying a portion of a portfolio, redeploying it, and providing leverage, adding RPMs to it, and creating a crack-resistant coating on the entire nest egg. And why they do that is insurance is a numbers game. If you can provide leverage over here, and even up to lifetime leverage, where no matter how long you needed care, if you were that male that needed care for 19 plus years in that one data point, you could have an insurance policy pay the entire thing. That's ultimate peace of mind. And that's one option that insurance companies have, including OneAmerica, who I represent. So what I want to do for just a couple minutes here, and we're going to open this up to Q&A after 12:30, half past the hour, is just explain a couple examples of how this would work for different people in different parts of their life. So what do? Well, we have a life insurance policy or an annuity as a base. Now, I rarely get asked the question, well, how does life insurance work if I die? Or how does an annuity work if I die? Pretty self-explanatory there. But what if I need long-term care? Can I use those monies? In other words, accelerate those monies out of that policy for a long-term care need? The answer is yes. And like we hear a lot, good things, options in life are never too good to be true. They're just too good to be free. So that's where the cost comes in. So you do put money into these policies, and whether you live a long life and need care, you have a benefit. Whether you pass away peacefully watching the game, you have a benefit, your family. And should you decide that this isn't right for you in the future, you have that walk away portion of the contract as well. That's why these base policies really help with clients with the valid concerns they have about those three things. If I died, never need a day of care, if I did need a whole bunch of care, or if I decided that a curveball was thrown at me in life and I really need to use this money for something else. You have that option when you have a life insurance or an annuity-based policy. But then in addition to that, you have even more leverage up to unlimited coverage, lifetime coverage we call it, with a rider. The industry often calls this a continuation of benefit. It's pure insurance beyond that life insurance or annuity contract at the base. All right, so let's put this into motion. I'm going to use hypotheticals, and I'm going to start with Asset Care. Now, that's the company's product name, but when you think Asset Care, I want you to think life insurance base and long-term care benefits that you can use from that. All right, so let's start with this typical couple. They're both 60 years old. What have they done? Well, they've managed to earn pretty good income and they're prepared for retirement. They're going to just coast into retirement. They've accumulated significant assets. Their main concern is about those dreaded things, not the short duration, maybe a hip replacement that I have longer rehab for. They could probably even write a check if they needed care for a couple months. They're concerned because there may be Alzheimer's or Parkinson's in their future based on family history. And they also understand that leverage, using pennies to protect dollars, is meaningful, and they appreciate lifetime protection. So let's put this into motion. Maybe they have a CD or cash liquidity that they want to lift and land. It's a single premium approach here. What does that do? Well, we can actually pay for the base and the rider in this situation. And what does it provide for long-term care benefits? Well, over $90,000 a year each. And that, if the policy issued tomorrow and the next day, literally, they needed care, it would trigger this claim. Now, while we're here, I'll give you just a brief idea of how insurance policies trigger a claim. And this is commoditized by and large in the industry. Most of the insurance products out there do the same thing. It's the inability of your mind or your body, the brain or the bones. Now, that's layman's terms, right? Insurance jargon is a severe cognitive impairment or activities of daily living. If you can't perform at least 2 out of 6 of those, then that would trigger a policy for the physical inability, or of course, that cognitive inability would be triggered by that diagnosis. Now, what happens if 2 people need care at the same time? So here, heaven forbid, both the male and the female need care at the same time. Do they have to share that $90,000? Absolutely not. They each, it's like turning on a faucet. They each have access to $90,000+ a year in this example. Now, think about this. We put in $200,000 and they could access this money pretty quickly. That's about a 45% guaranteed or equivalent rate of return on their money because they redeployed it. Now, try finding that rate of return in the market right now. Now, that doesn't mean that this is an investment product. What that means is if you needed care tomorrow, you don't have to try to partition your retirement portfolio. And maybe David or his team would be able to give you the exact number, but in this interest rate environment, how much money do you have to put aside just to garner $90,000 a year of income and not invade principal? I would say it's easily $2 million per person. So here we redeployed 200,000, or you could partition 4 million of your retirement portfolio and not use it for retirement living. That's why insurance is so powerful. All right, now let's look at a different client set. So these clients are younger. I would say they're financially fit. They're doing pretty well. They have high income and they have family history. Maybe they have been taking care of a parent, or they've heard of an uncle or an aunt that are needing a significant amount of care, and it's been devastating to the family and finances. They're also funding an HSA. Could they use that money? Well, yes. They also have plenty of life insurance. So why would I purchase even more life insurance? Really, nobody buys these insurance products for life insurance, they buy them for long-term care. That life insurance side of the contract provides guarantees. Your premiums can never go up. You have cash value accumulation. In other words, equity is growing in that contract. And of course, you have that death benefit should you never need care. So right back to the numbers as an example. If they wanted to have a budget of about $500 a month, $6,000 a year total, not each, we're going to be able to pay the base and the rider coverage here. And the rider, by the way, you could use out of an HSA and be tax efficient. Or it's not on the slide here, but you could actually use business dollars and get a tax deduction through the business. I've spent over 2 decades of my career helping clients, business owners, receive those tax deductions. I can help you as well. The base contract is about $3,600. That's where your cash value accumulation is. And then the other portion is a rider that you can pay for out of the HSA, either in its entirety, depending on your age, or certainly a significant amount. And what does it provide for long-term care? What's that income stream that it will kick in should they need care? About $71,000 a year each in this example, over $143,000 if both are on claim at the same time. Another thing you'll want to know here is that if you're going on claim, you do not pay premiums. So you don't pay the insurance company, unlike your auto or your homeowner's policy. The premiums are waived if you're on claim. You only pay premium to the company while you're healthy. All right, let's look at another example. These clients, they're in their early 70s, and maybe they have an IRA or a 401k and a qualified annuity sitting there that's really dormant. It's not being used. Could they transfer that over and use that to fund a concept? You bet. They're going to reposition that and help with their long-term care plan. They have other income to supplement if they have the really high long-term care cost to the family. But here's what we can do. So in this example, $200,000, it moves from the 401k or IRA in our example by trustee to trustee transfer over to the insurance company. And then it gets bonused currently at 20%. Now, those numbers are changing as of Friday end of business. The bonus is actually going down a little bit, but the concept still holds true. So here in this example, what the company does is over 10 years, they take equal distributions of the total amount in that product. So 240,000 divided by 10, there's your math of $24,000 a year of distributions. And that's a taxable event, right? Because it's pre-tax money. And we're spreading out that taxation over 10 years. So it's actually a positive for these clients. What happens? Well, the total premium of $200,000 will provide them over $57,000 a year each. And we showed you that lifetime long-term care rider. They cannot outlive these benefits. If they needed care for 2 years or 20 years or 30 years, it would continue to pay that amount. Now, we're often asked, well, maybe that's not enough. Could I buy more? Or do we have an inflation protection that actually grows that amount year over year? The answer is absolutely. You can put far more premium into these contracts, far less, and you can add what we call a COLA, or a compounding inflation, either 3 or 5% for additional premium, and you can get those numbers to move up every year for claim. All right, remember it doubles, right? So both people get to access the $57,000 roughly here a year should their care needs arise. Another example is a client. She's age 65 and she's concerned. She doesn't want to be a burden to her kids, their family scattered across the country. She has good income, but she does not want to pay more money out of pocket. What could we do? Well, we identified that she has an annuity in her portfolio and it has an income rider she's been paying for a bunch of years, and she doesn't even need to use it. She's not going to turn that income rider on for retirement lifestyle. Well, what could we do? We could turn the income rider on and then keep that 20% roughly in taxes in this hypothetical example to pay the taxes owed on that income, bring the remainder, the net amount, about $9,600 here, pay for the base and rider in our concept, and provide over $60,000 a year of long-term care claim expenses. That's over $5,000 a month. All right, now you've heard about it. I want to show you just a couple examples on annuity care. So asset care is a life insurance base. Annuity care, naturally, is an annuity care base. All right, let's look at this 71-year-old female. She has an annuity sitting already in her portfolio, earning a guaranteed 3%. It's actually pretty well compared to interest rates today, but it's just sitting there. What if something bad happened, she'd probably liquidate this asset first. Well, what could we do? Well, the first thing is, and EBW Financial, by way of fiduciary, has the best interest of the client paramount in these strategies. Suitability says that you really can't move that into an annuity that's not doing at least as good as what she has now. It's not the right thing for the client. But if we move from an interest rate focus to a value-based focus in the product, can we actually move that annuity? The answer is yes, because we're providing tax-free income should she need care and unlimited long-term care benefits. So that allows her to stay at home longer, allows the family to spend more time with her instead of on her care needs. So what does it look like for the amount of insurance that the product would pay out? So here's the $200,000. The majority of it is actually going into the base fixed interest deferred annuity, and the rest is paying the rider premium in a lump sum. It is providing over $59,000, almost $60,000 a year. It will trigger if she is claim eligible. Now think about that. She's 71 years old. Where could she put that money right now and get about a 29% equivalent rate of return? Because remember, if she needed care tomorrow, it would pay all $59,000 out in that year as long as she's claim eligible and as long as she needs care. Another example, here's a female. She's age 63 and she recently retired. She has a great strategy. EBW did an amazing job to help her out. She has good pension money to provide lifestyle for her. She purchased an annuity product years ago, and she had a life insurance benefit, unfortunately, because her husband passed away. It has a lot of growth in it. What are we able to do for her? Well, she's concerned about not having enough money and how am I going to pay these premiums? She doesn't have any children, but what could the insurance company do to pay for her care directly and take that burden off maybe an executor or a close family friend? Well, here's what we can do. We can move that money into an annuity and then provide additional leverage to the tune of another $450,000 on top of the $150,000 of base policy, providing well over $600,000 of long-term care coverage. And that would pay out over $75,000 a year for at least 8 years for her care. So when I think about this, I say, well, really it's about paying wholesale price for care if you needed it instead of retail price, dollar for dollar. Now, remember, nothing's free in life. So what did it cost the client? If she needed care, this could provide well over $600,000 for the $150,000 she put in. If she never needed a day of care, the vast majority of this base contract would actually move to the next generation. So I like to say, heads you win, tails you tie. There's really no downside. All right. So with that, what are action items for you, the folks that took the time to have this education? Well, just start talking to your financial advisor at EBW, meet with your family and have a real conversation. And I really don't mean, a laughing matter. This is eyeball to eyeball saying, what if? Explore the options to include insurance because generally it's the least expensive path compared to the alternative of estate planning and having to shift money and putting it into trust and all other things that have to be deployed in the absence of you being healthy enough or wealthy enough to take care of this situation. Then execute on it, complete the plan, let everybody know, your family, make sure your advisor is in the loop there. And now you've planned ahead. So with that, David, I'd like to bring you back on and see if there was any questions that our audience had today.
All right, thank you, Brian. That was great. We're taking a look now here about the questions.
David, so while you're
Brian,
looking, go ahead.
Yeah, we're looking. Let me ask you a question. One of the things you're hearing a lot about is some of these states mandating coverage. You heard it in Washington State. How does that play into this, and what is the insurance company's reactions to it?
Yeah, for those of you that have not heard, Washington State implemented a payroll tax. It was legislated into law and is going to be fully executed as of November 1st. And what that really means is there's been a race to the finish for people to buy private insurance. And the clock is running. In fact, it's running out. So it created really a situation where there was more demand than supply. Insurance companies could not keep up with it. Therefore, we will simply have to say no to thousands of people that tried to get long-term care insurance at the 11th hour, literally, right? So maybe if they would have planned ahead a couple years, it would have changed their lives, because now they're going to have to pay a portion of the payroll tax. Now, what does that mean to you? You're probably not in the state of Washington. Precedence has been set. So this will cascade across the country. In fact, there's 12 other states right now, a couple in particular, that have set up special commissions that want to implement something that is either exactly or similar to this. So the point is, prepare now and consider insurance before the flood happens and you may simply not be able to get it. And that's just from the Department of Insurance and the state's view. Now, from your view, be a little selfish. Don't do it because of that, because what the state's trying to do is offload some of that financial responsibility. Do it because of your family and your finances and your legacy and how you want to, if you had the oar in the water, how you want to navigate these waters should long-term care happen. Does that help, David?
Yeah, I think that it's important for all of us to understand that clearly the states, the governments are sending a very clear message that they do not want to be your long-term care policy. They want you planning for it and figuring out some other way around it. And if not, they're going to essentially charge you to be that policy. So we got another question here. How would your analysis change for those with existing long-term care policies but not life insurance?
Yeah, I spent the majority of my career actually with that, what I'll call traditional long-term care policy. And those policies are amazing. Now, some headwinds there is maybe there's rate increases. In other words, you have to pay more than you had to pay last year, and you may have to do that multiple times. The insurance companies are really trying to right the ship with those policies. So I view them almost holistically as try not to replace them, because even if you try to buy a policy today that may be on better footing financially as to how the contracts were priced, you're probably not going to see the same value even if you had multiple increases. Now, that's not universal. There's some situations where you may want to consider replacing, but the difference between really that policy and these policies with either a life or annuity policy is you have guarantees from start to finish. Now, it may not be as inexpensive, but remember the net cost of ownership, because you have either cash value, a death benefit that will pay out that will very much offset any premiums that you went from left pocket to right pocket. It's just a different type of a contract for a client that has the means to do it and wants to provide basically 100% benefit out of the policy. That's what these contracts do. Live, quit, or die, there's benefits no matter what. Now, could you actually add to or supplement? Absolutely. We are seeing that a lot now. So maybe you keep your current policy, traditional policy, and maybe instead of having an inflation rider on there that costs a lot of money, maybe you kind of stop that, freeze it in time, and then you use a portion of your portfolio to supplement or purchase a policy similar to the ones that I represent. Now, here's a trick question though, David. Which policy do you trigger first if you go on claim? Which one would you trigger first? Of course, pure long-term care insurance, that traditional policy, right? Because it's use it or lose it. You would use the policies that we talked about second place, right? After that policy is either maxed out on a monthly basis or you've exhausted it. And then you start tapping into these policies. Why? Because there's a death benefit that you can salvage if you don't need care for that long. So there are strategies being used out there where it's not taking this policy and throwing in trash and buying this one. It's actually coordinating them and creating an umbrella of long-term care planning. Does that help?
Yeah, I think it does, because it sort of dovetails to another question about, I currently have another company's policy. Does it make sense to switch to any of the discussed programs at the age of 74?
Yeah, and that's really a custom conversation. There's a few things going on there. We have to qualify the existing policy that they have and what their health is today and what their portfolio looks like. You know, when they bought the policy, maybe it was 10, 20 years ago, maybe they didn't have the inheritance. Maybe they didn't sell the company. Maybe they didn't have that CD sitting there earning point nothing, and they could actually put it to work here if, heaven forbid, they needed care. So it's not a quick answer. It really takes a one-on-one consultation to see if it makes sense.
All right, and then the follow-up to that was, what kind of health questions or current health issues would make someone ineligible for one of these long-term care policies?
Yeah, this is the tough thing. I have to actually be the bad cop in my job because the people, ironically, that want this the most may have had a health situation that simply will prevent them from ever getting an insurance policy. Some of the major things are already being diagnosed with dementia or Alzheimer's, MS, MD, in a wheelchair, using oxygen. All of those things I like to call the nasty ones that would disqualify you from even purchasing a product. But the nice thing about the products that you just heard about is that there is a lot of bandwidth from a health perspective that we can pivot. And I'll tell you, just at a high level, with life insurance, we can actually table rate all the way to table 8. So there's a lot of ability to offer or make an offer with additional premium. But then what we do is we analyze that and say, well, maybe we should look at annuity care because the underwriting is different and there's a much higher threshold for you to still get an offer with annuity care with some of the concepts that we can develop for you. I'll give you an example. If you didn't buy the rider on annuity care and just bought the base annuity care contract, we don't even do a phone interview. There's 5 knockout questions on the application, and we pull a national database of RX, prescription medications and MIB, and we can underwrite to that. So it's very quick. Now, why would anybody want just a base annuity care product, David? Well, the answer is they have a large annuity sitting there with a lot of tax deferral, and that's probably the money they're going to use first for their care. So why not bring that over and put it into a vehicle where they would never pay tax should they need long-term care? That's a federal law called the Pension Protection Act that says it's a tax-deferred status to a tax-free status should you need long-term care. So please make sure you reach out to the team at EVW to hear more about that. We can underwrite products all the way through age 87. That was a really good question, David.
All right, so one of the other questions is about the knockout questions. I'm assuming that the knockout questions are, like you talked about, the nasty. I'm in the wheelchair, I'm using oxygen, I have a cognitive impairment, and things of that like. Are those the typical knockout questions that you're referencing here?
They absolutely are. Another one would be, are you on Social Security disability, that sort of thing. And we can certainly provide those knockout questions. We can actually show you an application and we can send it right to the client so they can view that and see if it makes sense for them.
Okay. Well, Brian, I think we've got almost to the end of our time here, so I tell you what, let's wrap it up. I appreciate you doing this for us. It's been a wealth of information. I will circle back to anyone listening and saying, please, let's not implement these things without talking to your advisor, myself, somebody, so that we can make certain, because this is not a one-size-fits-all approach here, but it certainly could be one prong of your plan. So with that, Brian, I appreciate it. I hope to see you soon, and that will take care of it. If you all have any questions, just email us here or over at EBW. Send it to your advisor, send it to me, and we'll be happy to get back to you all.
Make it a great day.
All right, thank you.